If you walked into a casino, stacked $5 billion of money on the table, and said to the dealer, "I want to place a bet. If I lose, you get to keep all the $5 billion. But if I win, I only want you to pay me $17 million, nothing more." The dealer would probably think that you are crazy to give the casino such good odds and call the security guards to have you committed for a psychiatric evaluation. But in 2021, the top-tier executives at Credit Suisse did exactly that. They risked $5.5 billion of Credit Suisse's bank capital just to collect a microscopic $17.5 million in client fees from one guy. They took on a fatal mountain of risk for just a tiny fraction of a percent in return. Such was the absurdity and stupid math coming from a corporate giant. To understand how a multi-billion-dollar institution could be this blind, you have to look at the man, Bill Hwang. And he is the ultimate psychological paradox. He was financial royalty, top pedigree. He was known as a tiger cub, a hand-picked elite disciple of Julian Robertson, the billionaire legend and titan of modern-day hedge funds. Robertson's philosophy was famous for one thing: obsessive, hyper-rigorous analysis of company data. Bill Hwang was trained to be a precise financial surgeon, a protege. But inside the mind of this elite disciple lived a profound contradiction that the financial media completely glossed over. Bill Hwang didn't buy super yachts. He didn't own a fleet of supercars. He lived in a regular suburban neighborhood, drove an unremarkable Hyundai SUV, and spent his weekends hosting intensive Bible-reading marathons. He co-founded a massive religious charity and openly claimed his investments were a way to glorify God. He genuinely believed his wealth was divinely backed. He once stated that buying Google stock at a fair price was helping human society advance on behalf of the Almighty. And that is where the danger lies. Because when your investment thesis is backed by a divine mandate, traditional concepts like risk management, diversification, or stop losses look like a total lack of faith. His trading style wasn't patient or holy. It was hyper-concentrated, reckless even, and relied on a level of debt that would leave the traditional risk managers in total disbelief. After being banned by the SEC in 2012 for insider trading, he returned to the shadows. In his comeback in 2013, he created a private family office called Archegos Capital Management. Faith was about to meet catastrophic greed. He would eventually build an invisible $100 billion casino for the likes of Credit Suisse and more. At the heart of it all, Bill Hwang wanted to corner the market on a handful of volatile stocks. But Wall Street has strict rules. If you buy more than 5% of a company, you must declare it to the government through the SEC filings. So, he exploited a loophole with an instrument called total return swap. Think of it as a financial invisibility cloak. Instead of buying the shares himself, Bill Hwang went to major investment banks. He handed them a tiny fraction of collateral and had them buy the stocks. The banks legally owned the shares, but by contract, Bill Hwang got all the profits from the stocks of the swap contracts. Because these were private contracts, they were completely invisible to regulators. And here was the ultimate deception. Bank A had absolutely no idea that Hwang was doing the exact same thing with Bank B, C, and D. To the banks, Bill Hwang was a whale, a hyper-lucrative client generating tens of millions in fees for them. And if you have ever stepped foot inside an investment bank, you know exactly how this psychology works. The risk analysts flagged him, and the compliance software flagged the red alerts. But a managing director looking at an annual 8-figure commission bonus will always silence these noise and bend forward to the whale. In 2019, Credit Suisse committed its fatal sin. They were so desperate for Bill Hwang's business, they slashed his initial margin requirements from a standard 20% down to 7.5%, just so to have him on board. As you might have guessed, competition amongst investment banks for whale clienteles are insanely intense. To make the corporate absurdity complete, Credit Suisse's head of risk management at the time of the saga was a former sales and marketing executive with zero actual risk experience. By late March 2021, the music stopped. Bill Hwang's heavily concentrated stocks began to tank, triggering billions of dollars in margin calls. The banks realized their metrics were broken and frantically demanded extra collateral from Archegos. Look at how the whale responded. For 3 straight weeks, Archegos completely ghosted them. They dodged repeated emails, ignored urgent phone calls, and canceled high-level emergency meetings at the literal last minute, claiming they hadn't had time to look at the paperwork yet. And Credit Suisse, they just sat on their hands, terrified of upsetting their favorite client. What followed wasn't a calculated financial unwinding. It was a chaotic comedy of errors driven by raw, sweating panic. In the middle of the meltdown, Archegos' risk chief called UBS and audaciously asked them to wire $173 million out of their account. And the geniuses at UBS actually approved it. It was the financial equivalent of a bank robber asking the teller for a quick loan on his way out the door. But it gets weirder. Over at Goldman Sachs, a junior Archegos clerk was frantically trying to claw back cash to save the fund. He meant to withdraw $470 million from Goldman. Instead, in a blind, trembling panic, he fat-fingered the keyboard and accidentally wired Goldman Sachs another $470 million. Archegos begged for it back. Goldman Sachs essentially said, "No thanks, we're keeping it to cover your losses." On Thursday night, March 25th, 2021, the banks held a panicked, private emergency conference call. Credit Suisse, acting with classic corporate naivety, tried to propose a gentleman's agreement. They practically begged the other banks to freeze, hoping they could all slowly unwind the trades together over a month. But Goldman Sachs and Morgan Stanley weren't looking for a truce. They were looking at an escape hatch. They hung up the phone. While the Swiss executives at Credit Suisse were waiting for internal committees and compliance lawyers to sign off on paperwork, Goldman Sachs and Morgan Stanley acted like top predators. By Friday morning, they bypassed the public markets entirely, executing massive, multi-billion-dollar block trades. Guided by the sheer luck of that accidental $470 million wire, Goldman dumped Archegos' toxic assets onto the market first, saving themselves completely and leaving the slow, bureaucratic banks holding a burning building. At the end, Goldman walked away clean. Credit Suisse took a $5.5 billion bullet straight to the chest, all to protect a client that brought them a pathetic $17 million annual fee. The damage was fatal. The legendary Swiss institution never recovered, ultimately collapsing and being forcibly swallowed by its arch-rival UBS. Bill Hwang was found guilty of 10 federal charges and sentenced to 18 years in prison. Yet, through endless legal appeals, he has managed to dodge a prison cell and remains out on bail. In early 2026, Hwang took one final step, officially applying for a U.S. presidential pardon. It was a clear sign that even after a historic collapse, he was still willing to use every macro lever available to rewrite his ending. He still believes he did nothing wrong. He was just using market instruments exactly the way they were designed. It turns out the math problem wasn't the mistake. The mistake was believing that Wall Street's biggest egos could ever negotiate with basic arithmetic. Thanks for watching this far. Did Credit Suisse deserve to fall? Or were they just victims of a broken system? Share your thoughts and comments below. This is Secret Capital.